Okay, so well, you guys can keep visiting, but we're only going to talk about the first bullet point there on how to form a partnership. We'll get into the other stuff tomorrow when we don't have as much of a hectic schedule. Where are you? Oh, it's in my office. What you need to know, and I think this is in my notes, what you need to know about journalizing or doing the accounting for a partnership, it really acts just like all of the transactions we've been doing. You know, if we sell something on account, if we extend a notes receivable, or we sign a notes payable, that's all the same. It's just that the partnership type transactions from a journalizing perspective really boil down to these three. When the partnership is formed, there's a journal entry. When they divide their net income and loss among the partners, there's a journal entry. That's, of course, at the end of the fiscal period. And then what it looks like on all of the financial statements. There's just 2 or more people, so there's 2 or more capital accounts. There's 2 or more drawing accounts. And so things get a little bit complicated, if you will. But what you need to know from an accounting perspective is forming, dividing, and then presenting it on the financial statements all looks a little bit different than what we've been used to. Otherwise, all the journal entries are about the same. So if we take a look at these 2 partners, A. Rolfe and T. Shea, they're going to combine their sole proprietorships to start a partnership. And they're going to call it U.S. Software. Rolfe and Shea have the following assets prior to the formation of the partnership. What you need to know, you'll oftentimes be presented with, here's the book value of whatever we're trying to combine, and here's the fair value. Book value matters, but it's not journalized. Fair value is what is journalized. Because it's basically the 2 partners saying, I have this equipment. Well, I don't think your equipment is worth $5 grand. I think it's worth $4 grand. And they kind of come to terms as to what they believe the value is on all of it. Okay. Let's take a peek at the assets. Cash is cash. Okay. It looks like A. Rolfe has got $8 grand. T. Shea has 9. So those transfer over. Cash is cash. That value is the value. So cash is typically equal as they look at book value versus fair value. You can tell that A. Rolfe has some equipment, $5,000 worth, with accumulated depreciation at 2. So you would think it's valued at what? 3. The partners decide, however, it's really valued at 4. Here's what you need to know about accumulated depreciation. Accumulated depreciation gets wiped out. And I want to read to you exactly what the book says about accumulated depreciation. Let me find it. A partnership does not carry forward any accumulated depreciation from the books of a previous entry. So it gets wiped out. Instead, the partners decide, well, what's its new fair value? They threw this equipment a bone of $1,000 because really it's only valued at $3 grand based on the accumulated depreciation pile. The partners decided it was going to be valued at 4. So though it's wiped out, accumulated depreciation is not carried forward. Rather, they just say, all right, what's the new value of this $5,000 piece of equipment? It looks like T. Shea had some accounts receivable owed to him or her. We don't know if this is a male or female. The allowance for doubtful does get attached to it though. And then the partners will decide, okay, AR, we have $4 grand that's owed to you, T. Shea. We still have that $4 grand. But then we can decide, well, allowance for doubtful, he said it was 7, but they agreed that it was 1,000 instead. So does that make sense? book value, here's what it's truly worth, versus the new fair value that the partners decide. So if you take a look at, can I move that? A. Rolf and Tiche's assets each are valued, and what they try to get it to do, especially if it's a 50-50 split, is to get those assets to equal each other. So they're coming in at 50-50. And it's literally a sit-down, shout-out match until you get it to be fair. So they both agreed on getting their assets valued the same. How does this look like, or what does this look like then from a journal perspective? Well, I guess we're not quite there yet. This is basically what I just what I explained to you. So as the capital comes together from each camp and they form this partnership, included are the AR balances and the allowance for doubtful. Not included is that depreciation pile. It gets wiped out and you start with a clean slate. Rather, you just adjust the fair value to reflect that. But just know that this asset, along with its contra asset, is included, whereas that accumulated depreciation pile is not. Let's journalize. I hope this is in your supplemental handouts, is it? Good. So they're asking us to prepare entries for both partners. What did A. Rolf bring? Cash, and what else? Was he the one with the equipment or the AR? I can't remember. He had the equipment. Okay, are we including that contra asset with it? Accumulated depreciation. Remember, that gets wiped out and instead we value it with a fair value valuation. Okay, so he brings what to the table? Cash and equipment. My clicker is not behaving today. He brings $8,000 cash. Remember, that is out of his pocket and now it belongs to the business. So you see that asset go up. He brought in that type of asset. What other asset did he contribute to the business? Equipment. Now, we saw book value and fair value. What did the partners decide it was really worth? $4,000. Okay, you might want to write fair value next to that because it was really valued. I think it was, I forget. The equipment was valued at 5, had an accumulated depreciation pile at 2, but we don't count that as it comes in. Rather, the partners decide what it's really worth. And so his capital going in is that $12,000. And you could say that's forced math because it's your debits equaling your credits. The other partner is going to be worth 12 grand as well. What did the other partner contribute as they formed the partnership? Cash as well. He actually gave $9,000 of cash, and this is all referencing the pictures that we are already analyzed. What asset did he contribute? Accounts receivable valued at 4 grand. Whoa, partners are each valued at 12 grand, and I see a larger number here. What's going to offset that AR or that contra asset that devalues that? You guys remember what it's called? Allowance for doubtful. I see some of you saying it. Remember, this is a contra asset that is included in the formation of a partnership. It was actually valued at $700, but the other partner must have said, I don't like that you have people owing you money. We're going to bring that up to $1,000 instead of $700. That would, of course, then equal his or her, I keep saying his, but his or her capital at 12 grand. So can you tell that this is a 50-50 partnership just by the value? Now, we don't know that for sure. That's what we're going to get into, I think, next week, is what are the different partnership splits. It might be tomorrow, too. I can't remember. But by looking at the numbers, it to me says a 50-50 split. I actually want to stop and do these two brief exercises. If we have a little bit of time, great. I don't want to get into sharing net income because we're not going to have time for it today. We will spend all of tomorrow finishing this section of the book. So let's do brief exercise 12.1 and brief exercise 12.2. I think there's workbook pages for you. I would hope there is. Forgot my old notes are still here. Were you able to find workbook pages? Good. So we're going to do just two little ones. In the book, I'm on page 594. Barbara Ripley and Fred Nichols decide to organize the All-Star Partnership. Woo! It's talking about what they're investing in. Typically, it's a combination of assets and cash, which, of course, cash is an asset. Ripley invests $15,000 cash, while Nichols contributes $10,000 cash. Do you think it's pretty safe to say that book value and fair value are the same? Cash is cash. Would you agree? And equipment having a book value of $35,000. Prepared the journal entry to record Nichols' investment. So we're only looking at one of the partners, not both. What did Nichols bring to the table? Brought two things, cash and equipment. Okay. Now it's got a book value of $35,000. Keep reading. Assuming the equipment has a fair value of $4,000. Okay. Which number are we going to use? Fair value. Okay. So what did he contribute? Cash of $10,000. This is just, of course, for that one partner, not both. It's just for the Nichols partner. Not sure if I spelled that right. And then also the fair value of the equipment. It's actually surprising that it's worth more than what the book value is. Likely there was some accumulated depreciation that went with that, but that gets dissolved at the formation of a partnership. So what are we looking at for capital for this partner? Obviously $14,000. That again is a forced math number based on the assets that he's bringing. They didn't want us to do the other side of the partnership. Just that one. If we go on to brief exercise 12.2, Penner and Torres decide to merge their proprietorships into a partnership called Pentor. Very creative name for a partnership. The balance sheet the balance sheet of Torres company is as follows. And so they only want you doing the journal entry for that partner, not both of them. All right, if we take a look, accounts receivable less allowance for doubtful, and then equipment less the accumulated depreciation. I see two contra assets. Which one are we going to bring with to the partnership? Doubtful stuff, the stuff attached to the AR. Which one is going to get not completely wiped out, but kind of dissolved into the fair value, the accumulated depreciation? The partners agree that the net realizable value of the ARs is actually $14,500. So that's factoring in what it's valued at less the doubtful, and that the fair value of the equipment is actually $11,000 instead of the $13,000 that they're saying. Indicate how the accounts should appear in the opening balance sheet of the partnership. So this isn't actually a journal entry. This is a a partial balance sheet. Okay, we are going to bring in AR at its book value because the contra account does come with the partnership. So the AR book value is 16 grand. It gave you the accumulated, the allowance for doubtful, but here's where it gets a little bit tricky. Tell me what they said or they decided it's going to be worth. Keep 14.5. So this number is actually the forced one at this point. Okay, if you look at that Torres balance sheet, it was actually 1,200, but we bumped it to 15 to equal what the fair value was decided upon with the partners as they formed the partnership. Does that make sense, you guys? Can you see where you could easily screw that up? Yep. Remember, they're basing it off of the fair values of both the equipment and the ARs. AR is, I mean, they have $16,000 that's owed to them, and the fair value is basically what won't they see. Talk about the equipment. What's the equipment valued at? It is 11. Okay. Coming in, it was valued at 20 minus the $7,000 of accumulation, equaling what they deemed 13,000 for fair value, but the partners decided differently. The partners said the equipment is actually going to be valued 11 grand, and you do not bring that contra asset with you. That goes with that one. And that's it. The book does go on to give you a little, don't forget, accumulated depreciation should not be shown because a new company cannot have accumulated depreciation. It will start growing accumulated, but it's not the individual business or sole proprietorship. It's based on the partnership instead. So you might want to make a note of that little sentence that we've talked about, but I think the book does a nice job recapping it. I know we've got about 10 minutes to spare. However, I don't want to start talking about dividing net income and loss today because it would be cut off. So this is what I wanted to get accomplished today. We're going to have to hit the books pretty hard tomorrow though. And we will. We have no interruptions tomorrow.